Square, now known Block, got crushed after market. They were expected to lose 16 cents per share. They lost 18 cents per share. They were expected, the good news, to generate $4.33 billion in revenue. They actually did $4.4 billion. But here is the crazy part. Listen to these numbers. Seth, Cash App. Do you use Venmo or Cash App?
Venmo.
I use Venmo as well. Cash App beat this quarter on expectations. They're expected to do $2.52 billion in revenue. They did $2.62. Bitcoin was expected to do $1.7 billion in revenue. They did $1.7 billion in actuality. But here's the crazy part. I asked everybody here, get me the numbers from last year's same quarter. Guys, Cash App did $3.33 billion in revenue, and Bitcoin did $2.7 billion in revenue.
It's going down.
Down big time. I knew that was the case on Bitcoin. I'm very shocked about Cash App. I thought Cash App would have an increase, but it did not. I wonder what Venmo did with PayPal. We should look that up from last week's report on PayPal to look it up. Seth, you mind looking that up while I do the video?
Sure.
So guys, what does this mean? Well, let's go check out the stock. And if you're part of our software, it's always fun to keep along. But SQ is Block. Remember, they changed their name to Block because they wanted to be more about crypto and all that stuff. I think that's going to end up being a problem, and I wouldn't be surprised in the next 5 years if they change it to something else. But look at this. After hours, they're down 6.5%. They're being beaten up. So you see 6.5% and think, oh my God, time to buy. Not necessarily. So if you're new to this channel and you're watching me for the first time, you say, who is this handsome but very short man in front of me who talks very quickly? Well, I'm Paul. I'm a value investor. And I'm a value investor because I was a big nerd in high school and I got no chicks. But it allowed me to understand the world from the view. What was that, Seth?
I was there.
Seth was there, and he'd always stuff me in a locker, and he always made fun of me. But I sit there and view the world from the standpoint of it is possible to overpay for a good thing. I am buying a stream of cash flow, and I'm looking at it from a long-term perspective. Do I care about quarter-to-quarter results? Not necessarily, because to me, even though Square beat on earnings per share, I get more concerned about how their Cash App and Bitcoin revenue, they changed the name of their company to Block, and their Bitcoin revenue is down 35-40%. That is a scary thing to me. But my goal is to then use my 8-pillar process and my stock analyzer tool to be able to determine a price to pay for this company. This is what our community members do. We sit there and we look at investments, and if this makes sense to us, we sit there and start to acquire shares. Now, the unfortunate part is your job is to separate the stock from the company. And the reason I say that's unfortunate is nobody does that. Everybody looks, I love this company, therefore I love the stock. No, it is possible to have a wonderful, wonderful company, best company in the world, and have a terrible stock because it's overvalued. And that's what I want you to remember. So if you're watching this video and you like that, you sit there and go, man, that makes sense, subscribe to the channel. If you think to yourself, God, this guy is stupid, tell me I'm stupid in the comments, and you probably should stop watching the video because it ain't going to get any smarter for you then. But for me, I want to look at the company and project out forward. So let's look at their 8 pillars right now. Okay, guys. So first off, 5-year PE ratio. Seth, do you see this number?
Oh my God, 520?
522. This means if you add up all the profit over the last 5 years and take the market cap and divide it that profit, it's 522. So instead of a 1-year PE, I do a 5-year PE. Their 5-year price to free cash flow, it's a little more reasonable, 137. Still insane. Just to let you guys know, the 1-year PE and 1-year price to free cash flow should be around 15 or 16. They've increased their shares outstanding by 48%. This means they're diluting everyone like crazy. If they had 10 shares outstanding before, they basically have 15 shares outstanding now. So they're dividing up their profit by more and more people. In fact, look at it this way. 18 cents per share, if they kept the number of shares, actually been worse than that. They would actually lost more money per share because they would have had less shares to split up amongst. Tons of debt. They have revenue growth, but net income's down, and they have cash flow growth. So let's go check out their cash flow statement real quick. Actually, let's go look at their income statement real quick. Let's look at this revenue. Oh my Lord, look at this revenue. And of course, they are a provider of credit card processing, which I love. It tripled in COVID. Why? Because people were only buying online. Net income. Oh, and by the way, I'm going to disclose this. Here's how you're hearing me. You're probably like, oh my God, this guy's so biased. Guys, we use Square. In fact, we're one of Square called us and said we're one of the top users of their system.
Come on.
Absolutely.
Oh,
Everything money.
Oh, you're right.
Everything money. They have calls with us on a regular basis because of how much we use them. And they are a great processor for credit cards. But at the end of the day, separate the company from the stock price. You've got to remember that. Watch them cancel us now on our credit card processing. That would be epic. Like, hey, this video just came out. All right, so they've lost a lot of money in the last several years. Losses here, here, and here. Now, granted, this company keeps growing, but guys, look at the stock price. Seth, have you seen? You remember the stock price here? Look at the stock price. It hit a peak of, what was that, 288? 288.01 was a 52-week high, 52-week low of 57 recently, and now it's at 89. So we have to ask ourselves, what's the company worth? Now, remember, every investment's the present value of all future cash flow. Our job is to make assumptions about the future, guess what the cash flow and profit will be, and it'll tell us what to pay for the stock today, based on today's data. So before we go any further, Seth, did you find out PayPal's Venmo processing?
So Venmo is down as well. The year before,
oh, wow.
Year before, past performance, Q1, Venmo volume growth was plus 12%. Now it's only plus 6 in the most recent
quarter. So
it's
not down. It's just the growth is down.
Growth is down, yes.
It still grew. So that's a big concern of mine. Venmo grew, but it grew at a slower rate.
Yes.
And cash decreased. That's a problem, guys. That's a big problem. Now, their credit card processing was probably up is my guess, but this is the big thing here. So anyhow, going forward with this, let's make some assumptions about the future. Even though the revenue is down, I can understand why it's down. It's coming off major peaks with COVID being there last year. Coming off of COVID, people were still processing a lot of credit cards on the internet. So I'm going to make assumptions about the future. I'm going to do a 10-year analysis on the company. After we're done with this, you're going to see stock prices. Go rewatch this part because it's important to understand how we make assumptions on our system, okay? So I'm going to be conservative, guys. I'm going to call it 3, 6, and 9% revenue growth. It's a lot lower than the last 5 years, but remember, this is a fast-growing company, and for them to keep growing at a high rate will be they cannot grow at 65%, 61% a year for the next 10 years. It would be very difficult. Profit margin. Now, here's the benefit of profit margin. This is unrealistic. It's going to be way higher than this, hopefully over long, if this company sticks around. But it'll also show that what they need to do in order to justify the current price. So what's PayPal's profit margin, Seth? Do you mind looking that up for me?
Yeah,
because I want to compare it to that. Because guys, PayPal and Square are kind of similar companies. I prefer PayPal to use it in terms of when I go online and buy things, because Square is more for the retail establishments, the ones that are charging it. PayPal is more used for everyday transferring money, etc.
So gross profit's 54%. Profit margin is a little under 14%.
Okay. So they have a lot of growth to do still, probably go through growing pains. So I'm going to call it 7, 11, and 14. Because remember, they're probably going to have more low profit for a while before they get to the huge numbers.
I mean, Square's done an interesting thing in that they've infiltrated all small businesses, Paul, use that little Square hardware.
Oh, it's great. It's phenomenal.
Yeah. So
it's phenomenal.
Are there any other companies that have this hardware besides like other payment processing systems? Like
no,
right?
And that's what we love is Square.
Yeah,
is great.
The card readers. I do it on the fly.
You use it, don't you?
Yeah, on the fly, plug it in my phone, swipe cards, all of it.
It's phenomenal.
It is. Go ahead.
So free cash flow margin, they have free cash flow, 4 and 6%. I'm doing 4, 8, and 12% because as time goes on, as they establish more of the business, the free cash flow margin should increase. Now for PE, guys, at the end of 10 years, what PE do we want to assign to it? Remember, as a company gets bigger and bigger and bigger, the PE's got to be smaller and smaller because you just can't grow that much more. So I'm going to call it 13, 15, and 17. And the same with the price of free cash flow. And finally, for my desired return, guys, I usually do 12.5%, but here I'm going to do 15%. In an ETF, over long periods of time following the market, you should do 9 or 10%. There's a lot of unknowns here. We're putting in some higher margin than before, than that we actually have. So there's some things here that I want to make sure I hedge against. And this 15% gives me an ample margin of safety. Now, the company is currently down 5.5% after hours. It's at $84 a share. You're going to see 6 numbers pop up. Low, middle, and high on earnings multiple, low, middle, and high on free cash flow multiple. If they're all green, that does not mean go out and buy it. What does it mean, Seth?
Well,
great answer.
I was going to say,
it means go out and do more research. Make sure these assumptions are correct. Yeah. Go ahead, Seth.
the green buy, we don't want to trigger people to think it's a buy signal. It just means it's above.
And it means that if these assumptions are all true, then it might be something to buy. But the question is, I just did this off the cuff. These assumptions can be horribly wrong on the low or high side. You might be watching this right now going, Paul, you're an idiot. There's no way they're going to be able to do these kind of returns. It's going to be way lower. Or Paul, you're an idiot. Blockchain's the future. This is going to be 20% a year for the rest of the time. Okay. What you put in there is what matters to you. The question is it probable? So if it's all red, it doesn't mean just ignore it. If it's close to the price, do your research, etc. So
you really built the drama on this one.
Well, we have to. You know what it is, because everybody wants to see the price.
Sure.
So hit the analyze button, scroll down. Oh boy, actually we're not far off over here. The high side is 65 to 75. The low side is 12 to 20. In the middle is somewhere in the mid 30s to mid 40s. So guys, it's not terribly far off because it's not at 280 anymore. It's at 85. I would do more research, verify these assumptions are correct, and pay attention to the stock. If you like this and this makes sense to you, please subscribe to our channel. And if you like our 8-pillar process, if you like what I was doing there, please watch our next video on understanding our 8-pillar process to screen stocks. Thank you very much for your time.